according to sources cited by Reuters this week. Chinese policymakers are considering allowing the yuan to weaken significantly in 2025 to counter the economic impact of a potential 60% tariff on Chinese imports by the United States. This move would mark a major shift in Beijing's currency strategy as the country grapples with mounting economic pressures. So, what will happen when the yuan weakens? Will it become a double-edged sword? President-elect Donald Trump's proposed tariffs, 10% on all imports and a significant 60% on Chinese goods, have led Beijing to consider devaluation as a countermeasure. A weaker yuan could make Chinese exports cheaper, potentially offsetting the impact of U.S. tariffs. However, Beijing is in a delicate situation. Lin Song, an analyst at ING, notes that the People's Bank of China is expected to mount a strong defense of the yuan. The central bank is aware that a sharp fall in the renminbi could provoke even harsher retaliatory measures from Washington. In response to these rumors, Financial News, a publication affiliated with the PBOC, asserted that the yuan remains stable and predicted it could strengthen by the end of the year. And China's real issue is a balance sheet recession. Tariffs are just one of the challenges China is facing. The country is grappling with multiple economic issues, including a collapsing housing market, a weak stock market, and decreasing consumer activity. Alfonso Pecatiello, Chief Investing Officer at Palinuro Capital and founder of the Macro Compass, explained, the planned gentle deleveraging of the housing market has turned into a severe balance sheet recession. Since 2021, trillions of wealth tied to real estate have been wiped out. A balance sheet recession is harsh. In such a scenario, consumers and businesses focus on repairing their finances rather than spending or investing, making traditional monetary policy tools like interest rate cuts or currency devaluation largely ineffective. This economic slowdown is reminiscent of the Eurozone debt crisis of 2011 to 2012, when fiscal austerity measures rendered monetary policy largely ineffective in stimulating the real economy. Beijing's policy response has been seen as lacking boldness. Authorities have proposed modest fiscal stimulus measures, but these have been insufficient to make a significant impact. To stabilize markets, the government has introduced mechanisms to prevent investors from shorting Chinese stocks. Additionally, the central bank has aggressively cut interest rates to increase liquidity. Despite these efforts, the economy has not seen substantial improvement, leading analysts and investors to question Beijing's strategy. The iShares MSCI China ETF MCHI, which tracks Chinese equities, remains almost 50% below its peak in February 2021. Why a weaker yuan won't be the solution? Weakening the yuan might seem like a straightforward fix, but economists doubt its effectiveness. Pecatiello explains that in a balance sheet recession, lowering interest rates or weakening the currency won't spur spending by consumers and businesses. They are struggling and witnessing their net worth drop due to ongoing property market declines. In essence, a weaker currency won't repair lost wealth or restore confidence among Chinese households and businesses. According to Pecatiello, China's solution may be found in implementing large, targeted fiscal stimulus. Rather than using broad, general measures, some experts suggest that the government could focus significant spending on struggling companies and consumers. The key question is whether Beijing will take decisive steps toward this kind of fiscal stimulus. So let's see what happens. Like and subscribe to support my channel. Thank you.